Hello, everyone. Thank you for coming to my presentation. Before I start, I just want to thank Evan for organizing everything, and thank you for inviting me. Today, I'm going to talk about a piece of research I've done with my research group to look into the behavioral patterns, what we call behavioral fingerprint, in the Bitcoin markets. This is the rough plan for today's talk. I will talk a little bit about Bitcoin markets, and that brings out why we're interested in this piece of research. And then I will explain a little bit on the literature that's relevant. And then we will dive straight into the modeling part to see how we actually set out to study the different types of behavior in the markets. And finally, you will see the full empirical example to demonstrate what we've been talking about. Okay, so first of all, the Bitcoin market. I think up to today, Bitcoin is no longer a strange idea to people. It's one of the largest cryptocurrency traded in the market. And there's a lot of debates about whether it's still a currency or actually is more perceived or actually used as investment assets. But by design, cryptocurrency originally was designed as a currency, very much like our fiat currency, but with kind of very little constraint on how and who can access it, and there's a strong plea of transparency of that. But ultimately, Bitcoin and other cryptocurrencies were designed to be like a currency, especially with purchasing power. But what we've observed in the market is that a lot of investors, especially we call speculative investors, actually sees it more as investment assets. So what is it? Is it a traditional currency with some new features, or is it actually more like an investment asset like a stock or some kind of derivatives? So why don't we look into some kind of data to show this? So we actually took the Bitcoin and then just plotted against the different kind of currencies. So you can see in the graph A, B, or C, we treat it as exchange rate. And you can clearly see that the behavior of the Bitcoin, and especially from the statistics, it's not very much like a currency. You can see that the mean levels across different kind of currencies are quite different, media are quite different, but the problem is that the kurtosis is quite big, and standard deviation also varies a lot, especially the Bitcoin against the major currency, the dollars. You can see that the standard deviation is quite high. And then what we did is that we took the price of the Bitcoin against USD, which you can see it as interest rate. So basically in A, you see it as a Bitcoin. And if we compare that with Tesla or Barclays, that some are highly liquid and frequently traded kind of stocks, then if you look at their stats, you can clearly see the Bitcoin, for example, the average return means level, average price, the mean level, or the standard deviation or skewness or kurtosis, whatever statistics you look at, they are behaving much more like each other. So if you compare these stats, seeing in the first kind of experiment, you can see that the Bitcoin's statistics are not so similar to other kind of exchange rate currency related the variables. But if you look at that in comparison to stocks, it's very much they're very much kind of mimicking each other's behavior. So in that sense, it proves that the Bitcoin possibly at its current state is more of an investment asset rather than, really fulfilling its full currency functionality. And we also kind of observe that in this market, and usually the returns of the Bitcoin tend to be quite high, and that is associated with high risk as well. And we also observed from this return distribution, it has this effect tails, and especially very long thin tails, which again shows the risk profile of this new asset is quite high. And this market has its own unique features, and it's 24/7 market. It's not like a traditional stocks traded on stock exchange. You will have opening time, closing time. And also because it's fundamental blockchain design, and we noticed that on average, it's a design that every single block, so every trade will be recorded on the blockchain, and roughly by design, the every block should arrive in 10 minutes. And in empirical evidence, which we will show later on, that's exactly bang on. So it has a very structured kind of design in terms of its infrastructure and based on blockchain, but also at the same time, it has a lot of features coinciding with highly risk or liquid assets. In this market, what we really noticed that since 2018, the market become very, very, very active. And then now, after various kind of major events, so for example, Elon Musk been tweeting back in the days about Bitcoin, and we also know that there are some kind of crackdowns of the cryptocurrency, etc. So after all these, you can imagine how active they are. But what we definitely can see, this market become very active since 2018. So what we are looking at here really is kind of that period since 2018 onwards. We observe like a dramatic increase of IP addresses. So each IP address, you can see it as a kind of trading ID type of stuff. So basically, you can see a lot more here with the numbers I pointed out here. Just during the 2018 and 2021 period, you can see that the IP addresses or the participants in this space, quickly doubled. Another interesting we found out based on what we did in the studies, that during this period, although the addresses kind of dramatically doubled, but the activities are very, very concentrated. So, for example, we noticed that 91.22% these addresses actually throughout the lifetime, the period we're looking at between 2018 and 2021, don't have more than 2 transactions. That tells us that a lot of people possibly will join to try out to see what this is, and then they just quickly lose interest, or they just don't really know what to do about it. But on the other hand, we also noticed that some most active addresses are really active. So for example, if you look at this address here, I put down in the last bullet point, and this address appeared on the 20th of October in 2017, and it appeared in this block number. It actually kind of still up to today has averaged over 80,000 kind of transactions per month. And just within our observing period, it has more than 3.5 million transactions. So in comparison to the 91% of the population in this space, you have who doesn't really do much in the space. You have the other extreme, that somebody like this one person has so much transactions overall and on average each month. So that actually really make us think not only what is this market like, we want to know who are actually in this market. So because we are talking about roughly just over 8% of the entire population, it's super active, is responsible for all these transactions, all these high returns, high risk, and the highly volatile market. And also we, from the example I said earlier, the top kind of end of participants have a huge concentration in terms of their activity in the market. So you naturally wonder whether there's some kind of a strong speculation in the space for whatever reason. So that thought really comes from the market microstructure perspective. We know that people, who have technical or technology advantage, for example, their trading facilities can cope with very fast trading, high frequency trading, etc. Or people who have information advantage, and or people who have high, kind of risk appetite, even so much so that they risk, seeking people, they tend to be associated with very speculative behavior. And there are currently some kind of research in the market microstructure specifically focusing on Bitcoin markets. You can see I listed here. And the general idea or general findings is that, in the Bitcoin market, it's the behavior, especially the price movement and the volatility profile, etc., is very much behaving like the high frequency trading. You will see a lot of frictions in trading. You will see substantial trading volumes from very small portion of concentrated traders, or we hear called traders, like the IP addresses and etc. So basically, inspired by this, we wanted to see, really to understand who are in this kind of new space. And even so, there's only, say, 8 to 9% people very active, and then, counting for all this massive volume of transactions. Do they behave the same? And who are actually, the real kind of speculators in this market? And who are, like, the fair traders, what we call, although they may have information advantage, or they have speed advantage, or maybe they just are, like, say, for example, the hedge fund traders, or those experienced traders who handle ETFs, but they are, doing reasonable things, or we call them the market behavior of these people are regular behaviors, and who actually are the genuine speculators. Or maybe all our, assumptions here are not backed up by any evidence. So basically, just with that kind of curiosity and some kind of observed evidence, we decided that we want to understand, and who are in the space and what they do. So just to be more specific, that we do observe that there's a large population addresses in this space who do very little. So we call them taste traders. And that could be people who were just attracted to this market, or generally they are very curious about things, and they just dip into the water and have taste, and they then really don't go deeper again. But we really want to see, for the rest of roughly 8 to 9% of the participants, what they do, who they are, etc. Because what we are interested are their behaviors. So, and what we will need to do is to really look into all these IP addresses and then associated transactions. So we haven't, in this study, we haven't really looking at their trading behavior, because often, for finance, you will not be able to access the trader ID. And if you, in a say traditional finance market, if you know who is doing what, you pretty much have the gold. That's usually the difficult bit. But now with the machine learning models, etc., we could design or engineer the model in a sense that we read in a lot of information, and we use those information to kind of review the behavior of people. So we don't necessarily need to know exactly who did what, but we can roughly know in the market what type of people exist and what they do. So basically what we found, just this is quick kind of highlight of our findings before we dive in. And so we basically we kind of borrow the concept from the traditional market of typical trader types or participant types, or you call market participant types. And then we assigned 5 different types, including like taste traders or high frequency traders or market makers, etc. I will introduce them very quickly after we get into the modeling part. And we definitely find very distinctive 5 different types of traders. And we found that each traders have a very unique trading behavior. So, for example, the fundamental traders are very much in the space like the traditional fundamental traders, and the technical traders they trade on information signal. They don't really look into the fundamentals, where the price or liquidity moves. They don't. They look at, say, patterns, for example, and they look at the charting, that kind of thing. And we will really looking into that. And also from the overall market perspective, we noticed that even within those 8 to 9% of people who are very active in the space, and there is very strong clustering effect in those people. Okay, so the certain groups are very, very, in terms of portion, they're very, very small, but they count for a large amount of volumes in terms of transaction. So all these insights could really help us understand who are in the market and what do they do. And then the regulators could very well understand, where the liquidity comes from in the markets and where liquidity is taken by whom, and then how they're going to, design a regulatory side of things to keep the orderly market. Okay. Now we get to the real engineering bit. So what we did is that between the January 1st, 2018 to the January 31st of 2021, we basically tracked every single IP address that have been in the Bitcoin market, and we collected all the on-chain transactions. And so that's really a massive data set, which we will get to in a minute. And then for us to track all this Bitcoin data, we'll definitely need ID. The ID is IP address. So every single IP address is a unique ID. So you can see it as a traditional trader ID in the traditional market. And we will need to know for each transaction when it arrives and in which block of the whole blockchain it arrives. And we need to know the total number of transactions, and we need to know the total number of addresses. And for the Bitcoin part, and for each address to have a transaction, I either send a Bitcoin or receive a Bitcoin. So we will also mark that. So we know every transaction, whether it's sent, or it's received. And we also know the time horizon as well. So knowing the structure of the Bitcoin data is slightly different from traditional. So for example, we will have the features that mark the blockchain side of the Bitcoin. So for example, the blocks, the block location, and the send and the receive of the transaction, and which block that transaction locates in. So that's kind of the unique side of it. And then we have to define all this. So I'm not going to go into this to bore you, but these, just quickly to go through, these are the key features we use to describe Bitcoin. So for example, we will for any address I or IP I, we will need we actually collect the total number of transactions of it and total number of blocks of it. And also we look at from the time perspective. So for example, the DJI is showing for address I which day and what time of that day the J's transaction arrived. Either it's sent or it's received. We then also will know something like more about the address and the transaction number. So we count the number of transactions for the address I in any of the day K. I mean, and we want to know the number of for a particular address, total number, transaction number of a week and of a month. And to define this, or the purpose is really to help us to define different types of features so that we can study the behavior. So we actually can design over like 30 different type features, and then we put the features into the modeling framework we chose here, which is K-means, and run through the experiment and filter out those features that don't converge. So basically, we design a lot of features and we try them in our algorithm. If they don't really converge, that means that they just won't work. Those features will not fit the model, and we'll filter them out. So eventually we end up with these 12 features, and I just handpick a few because then later on when we move on, I'm going to talk about these features by categories and for specific purpose. So for example, we found useful features including number of transactions per block, or the average number of transactions per day or per week. And we also see that the deviation of the number of transactions per week or median of that. And we also pick up the active time ratio, for example. So for example, throughout the entire period, for particular address I, how active, is that 80% of the time this address is busy doing transactions, or only 2% of the time this address is busy doing things. And we also look at other kind of time ratios to see, transaction days to against. So how many days address I are actually having transactions, and what's the proportion of that to the entire lifetime. But overall, we have all these 12 features. I'm going to go through to say how we actually categorize these features. Basically, we have 12 features, and we have 4 features to look at each of the 3 categories of behavior characteristics. So the first 4 features, like number of transactions per day or per block, that kind of thing, it's called trading frequency features. So we're basically looking at different transaction counts, and we also kind of report the standard deviation. And the second one is the waiting time features. We want to understand, how they behave. Do they, like for example, we say go shopping online, is somebody very active, buying things every day, or this person have it's very regular, like say 3 transactions per month, per week, and at roughly the same time, or it's just completely very random. All these IP address, it's very active, relatively speaking, but the pattern is that they have one transaction at time X, and then it takes like 3 months for you to spot another transaction. So we want to understand, so between transactions, how long they wait before they actually execute the next transaction. And the final category of features is active trading features. So we found a different time, like time lifetime ratio, that kind of stuff. So we basically have all these 12 features, but 4 and 4 in each category. And just quickly to say, when we did this research, it was back to 2022. So we didn't really the purpose is to understand how they behave, so we are literally just using some existing methods, and we actually haven't gone into using all kinds of fancy machine learning algorithms. We literally just pick the easiest one, the k-means. And the k-means literally is an algorithm that you can fit the data into it. And the purpose is that the data points that have the similar features will cluster. So like this graph illustrates, all the red dots, blue or green dots will cluster together. So what we are here to do is we borrow the concept to define 5 different type of traders and fit into all the transaction data Bitcoin market. And then, people behave similarly, will fall into the same clusters. And how do we classify all these? We classify by these 12 behavioral features we define in 3 categories. That's the whole concept. Okay, let's move to the real example part. As I mentioned, that we were looking at the period between the beginning of 2018 to beginning of 2021, and this over 6 million addresses are used after we clean the data. And then when we deal with the data, there are some work being done. So for example, if address has less than 3 trades throughout the life, the entire sample period, or they throughout the sample period, their total active time is less than a minute, we possibly will just exclude. So basically, we did move out some of the outliers. And you can see that when we plot the QQ plot of the block arrivals of all these addresses, and it works out that our empirical data suggests every block, the time it takes 9.33 minutes. It's pretty much bang on, because in theory, every block is arriving in 10 minutes. So it's pretty accurate. And in the graph on the bottom right-hand side, that's the new trade arrival during the period. You can see that after we exclude some of the outlier addresses, we can be quite confident that our data set, is quite valid. That got a lot of. You can see the arrival pattern is pretty frequent and fit for the purpose for the study. So we borrowed the concept in the traditional trading markets. These are very typical, trader types. We have taster traders, fundamental traders, technical traders, market makers, and high frequency traders. So these are very familiar concepts we borrowed. Then what we did is to run the k-means. What we really found out is that empirically speaking, we look at the trading frequency features. We can clearly see that the trading frequency, for example, for the taste traders, the frequency is relatively low. But most distinctive is that the high frequency traders, well, by the name of it, those are the people trading very frequently. They definitely trade a lot. So for example, we only find 269 addresses of our entire sample, which is overall, 6 million IP address. We found that 5.2 million out of this 6 million IP addresses, the classification using k-means are very stable. So that again shows that k-means is valid. So based on that, we found in terms of trading frequency, the high frequency traders, only about 269 IP addresses fall into that cluster, and they have roughly 13, 14 transactions per block. But all other categories like fundamental traders or technical traders only trade 1 or 2 per block. And per day, the high frequency traders is trading 560 trades. And in comparison, other categories, you're talking about the 1 or 2. And market makers also is fairly frequent, behaving fairly frequently. They kind of make markets 70 times a day. But you can clearly see the difference between the class 4, which is market maker, and class 5, which is high frequency trader. When we look into the waiting time features, again, it's very, very distinctive. That's fundamental traders and they technical traders. The average waiting time is like days, but if you look at the market maker and high frequency trader, they literally wait for minutes. So, for example, there's 269 high frequency traders, and they on average they take 0.11 days. That's roughly about 20 minutes, something like that, to take, before they actually go on to make trade. That makes sense, right? Because we were saying on average per day, they're going to trade about 560, transactions. But in comparison, if you look at technical traders, they take about 5 days. Every 5 days, they have a trade. Or if you look at fundamental traders, they take roughly about 22 to 23 days to trade. And that also makes sense to match their definition. So, for example, for fundamental trader, they don't trade unless they see the fundamental movement, the price go up and down, and they possibly buy low, sell high. Unless they identify those fundamental patterns, they will not execute the transaction. So the final features is to look at active trading features. Again, we notice that every category, every type of traders behave very differently, and the technical traders are also very active. And 88% of the life they're active. And the interesting thing is the high frequency trader actually are not always active throughout the life. Only 31% of the time they are active, in comparison to, say, 72% active life of the market makers. And that clearly indicates to us that, like typical high frequency trader, they either take a speed advantage or information advantage. Put in very simple words, they don't always trade in the sense of the life activeness. But if they trade a lot, they trade fast. And if they sense the information advantage or they sense speed advantage, they just go at it straight away. But market makers, in contrast, although they are also very frequent, but their purpose is to make their profits through market making rather than through trading itself directly. So you can see that they're much more active throughout this process. Letting alone the technical traders are always looking for signals throughout their life, etc. So basically, if we look at the category 2, 3, 4, 5, that is technical trader, fundamental trader, market maker, and high frequency traders, they are all the active traders comparing to the taste traders. Their active time all higher than, say, taste traders. Taste traders tend to only be active throughout life 20% of the time. And that could be normal people like you and me. We get in, we try it, sometimes it goes well, we continue, but then we lose interest, that kind of thing. The behavior is very, very random. And then I have a few slides to showcase the histogram or of different types of traders. If you have time, you can go through to look at this in detail. So, for example, this one is fundamental traders. You can see that the histograms of the features of each category, are very, very different. So, for example, we plotted the histogram of active days percentage or the waiting time, etc. Just to flip through all this very quickly, you can just say each type of traders behave very, very differently. The statistical features are very, very different. Finally, we just give a couple of case, examples. So this one is this particular address, you actually can go to the blockchain.com to search this address. You will be able to trace all the transactions that took place since this address appeared in the space. You can clearly see that the total balance of the account in terms of Bitcoin is looking like this, and the daily transaction volume is looking like this in the middle graph, and the bottom is showing you the number of transactions. This is one of the typical fundamental traders. You see, they don't trade until they identify signals. So you can see that the where these spikes, where this the plot shows some kind of plot, some patterns, is where they identify the signals. But if you look at the technical traders plot, they are very, very different from fundamental traders. They don't look at fundamentals, they look for signals, and their patterns look very different in terms of the trade balance, daily transaction volume, and the number of transactions. And the market makers, again, look very different. And finally, high frequency traders, it has very distinctive features of this clustering of trades, etc. So finally, what I want to show you is that topology, the overall typology of this. So overall, we found that the high frequency traders, we call them Bitcoin sharks. They only count 0.0005% of the entire population, but they have 21% active lifetime, or throughout the life, and then they trade quite a lot a day, and their waiting time is fairly short, and they are sharp, they're aggressive, they're really speculators. The market makers tend to make their profits through making the market. They're more active throughout life, and they trade again frequent, so they're more of intraday traders. We think they are liquidity takers. Technical traders are very sneaky, and that's why we put we call them a fly fox, and they are again very small portions throughout the whole population. They are looking for signals to trade. The fundamental traders, we call them are hard-working donkeys. They really are diligently looking for the fundamental price movement, and they're very rational traders. And finally, taste traders, we call them, they're relaxing sheep. So they literally trying to come out and to smell the grass, to smell the rose. But overall, you can see that we have 5 different types of traders, and the population of them is really like the pyramids. At the very top, you have tiny bits of the traders, and responsible for taking up the entire market liquidity, and they're very aggressive. They are very speculative. But on the bottom part, you have the taste traders provide a little bit of liquidity. Fundamental traders provide lots of liquidity to be, for the liquidity to be taken by some of the sneaky traders on the top. So that's pretty much all my talk, and we personally find to understand who are in the market are incredibly useful for regulators to, for example, to identify issues like spoofing, and also the regulators could see who are actually providing liquidity, who are actually consuming liquidity, and roughly who are the ones speculating the market, spoofing the market, and that could potentially cause the market liquidity dry up. I think those points are all very important and useful for both regulators and investors. Thank you very much for listening. If you have further questions, please do reach out and get in touch. Thank you.